I want to talk to you about the Schedule F, farm and ranch. If you file a Schedule F, this video is for you. There are certain things that apply to farmers and ranchers specifically and not others. So if you and your CPA are not talking about the things I'm going to go over in this video, then you're probably leaving money on the table. I see Schedule Fs misprepared more than any other document. In my day-to-day practice, I see this daily. Schedule F is not just another business schedule. There are items specific to farmers and ranchers, and the nature of the business is such that there is volatility in income. There's volatility in commodity prices. There's weather-related volatility. And all of these things fit together, and the rules are specialized to accommodate for that volatility. The tax code recognizes it, but you've got to know the rules, and that's the problem. So many professionals don't know farm and ranch specific tax rules. So today we're going to go through these things. I'm going to tell you what I see. I've been doing this 30 years, and I see this daily in my practice. Let's take the first thing. Let's take step one. That is, are you a farm and ranch business for profit? I've got a whole separate video on that. So if you need to go back and look at what I'm talking about, go watch that video. Let's assume that you are a farm and ranch with a profit motive, filing Schedule F. The very first thing I want to talk about is income averaging. What this allows, and I'm not going to get into the specifics because this is not tax advice, individual tax advice. These are the questions you need to take to your professional and ask if you aren't already talking about these things. Income averaging. Farmers and ranchers can elect qualified farm income to average over the previous 3 years. What does this do, you say? Well, it enables you to have volatility in years without the volatility in tax rates. You may have 1 year where you have a large income. The next year you may have a loss or a very small income. The following year, large income again. You find yourself getting bumped up into these higher tax brackets in those higher years. If you were allowed to average that income, you may never hit the 24% bracket, the 22% bracket. You may be down in the 15% bracket, let's say. If you average that. So that's what farm income averaging allows you to do. And it's a case-by-case basis. It's not right for everyone. It's not wrong for everyone. There are other items of income, gains and losses sometimes on farm property, things of that nature that you can count in that farm and ranch income. So that's step number one, farm and ranch income averaging. Another rule that people often miss is regarding penalties for underpayment. Let's say you didn't make your estimated tax payments or didn't make them timely, and you're subject to a penalty. You take your information to your preparer. There's a penalty, $1,000, $2,000. I've reviewed returns before and had people bring me a return that had a penalty on it. They qualified under this rule if 2/3 of your income, gross income, is from farming or ranching activities. You can elect to file Form 2210F, and all that is a penalty worksheet. But if you file by March 1st and pay by March 1st, that penalty's gone. So I had a taxpayer come to me and want me to look at his return. And this was recently. We're before the March 1st deadline. And I said, yeah, your return is right. We corrected a few things, but we saved some money just with it, and that's why I did this video today because people don't know. And so we saved some money. And I said, do you want to file it by March 1st? And he was baffled. And turns out that, yes, we could file it by March 1st and save $1,500, $1,700 just in penalties because he qualified. So that's what we did. So know that if you qualify as for 2210F, for the penalty form 2210F, you read the instructions, you determine if you qualify. If you do, and you file and pay by March 1st, you eliminate those penalties. So that's a saving item in itself. The IRS does this because income does not come in evenly for farmers and ranchers. There may be just one large inflow of income a year. So the IRS allows the avoidance of penalties if you just file and pay by March the 1st. That's it. The next big one that I see, and this is a big one, I'm not going to tell you if you qualify. If you receive crop insurance, either entire crop losses or devastation, quality losses, sometimes there's typically two types, volume losses and quality losses. Whatever it is, if you have crop insurance proceeds that you receive for a crop that you normally sell in the following year, let me say it again. If you have crop insurance proceeds that you receive for a crop that you normally sell in the following year, that portion that you would normally sell in the following year, you can defer. You can defer crop insurance proceeds. You've got to fill out the forms accurately. You've got to read the rules and see if you qualify. Again, talk to your professional. But those clients of mine that have grain crops, they normally sell in the following year. If I'm in the year 2025 and I receive crop insurance proceeds for 24 crop and 25 crop, the 24 crop cannot be deferred. It needs to be recognized because we're in 2025 and that's the year you would normally sell that crop. The 2025 portion can be deferred. You can elect to defer it to 2026. So know that. That's huge. It doesn't eliminate the taxation, but it definitely could even out those years. So just know that you can do that. Deferral is a powerful tool. Let's talk about drought and livestock sales, or what we call involuntary conversions. This occurred. These are things that I do daily. I hate to keep saying this occurred, but I do it daily. We're in a drought area, no doubt. The rainfall data that I've collected and the drought coverage map indicates it clearly. I have clients that normally cull 20% of their herd, 10% of their herd, whatever it is, their normal cull rate. This year come to me and I see calf sales, livestock sales, cow sales, bull sales, breeding animals, things of that nature. I ask, why did you sell so many breeding animals? And the answer was, I couldn't afford to feed them. We couldn't get hay. We couldn't grow our hay. I'm not going to buy hay. So if that has occurred and you've involuntarily converted those assets, those breeding animals, not your calves, not your normal cull cows, cull crop, but those that you've sold in excess of your normal culling activities, those can be deferred and not recognized, actually. You have up to 2 years to replace those animals. So if you qualify and the excess you sold because of an involuntary act, you better know the rules. Don't go and just put this directly on your tax return and say, I heard a guy tell me on YouTube, because it's not going to work. Go to your professional, talk about this. But if it fits, you can not recognize the sale of those animals. You have 2 years to replace them. That means you've got to buy them back. You don't get a deduction again. You didn't recognize the income. When you buy them back, you don't get the deduction. You don't get to depreciate, none of that stuff. Okay, so those are the things that I see. Farm tax planning strategy is different. You need to be speaking and meeting with your professional about these items. If you're not, you're just filing a return. There's no planning involved. If you have questions, throw them in the comments, please. Like, subscribe, all of that good stuff. It helps me stay motivated. If you want specific videos on specific topics, let me know. I'll be happy to do those. Thanks for watching.